All right, welcome back, Nicole. So today we're going to talk about all things insurance. When we talk about insurance, I think a lot of people are familiar with insurances like private health insurance, car insurance, home and contents, and all those sorts of things. But when you look in the financial planning perspective realm, what are the sort of types of insurances we should be thinking about?
Oh, yes. So within financial, they're called personal insurances, and it could be a little bit confusing because health insurance is also quite a personal insurance as well. But within financial planning, we deal with life insurance, total and permanent disability insurance, trauma insurance, sometimes that's called critical illness insurance, and we also deal with income protection insurance. So I think we'll probably go through all those in a little bit of detail, but they all they connect and they sometimes overlap, but it'll be good for me to sort of explain those things to your listeners so that you can understand when you see those words in your super fund or somewhere else what they actually mean. So yeah. So should we go through? Or?
Yeah, look, absolutely. The first thing I just wanted to ask you though is there seems to be, when you look at participation rates in insurance, there seems to be a lot of people who don't enter in those types of policies. So most people have car insurance, but is that a thing of people not just understanding what the insurances are, or talk us through what's your experience around that?
Well, yeah, I've got some stats on that really, and 79% of people have car insurance, 77% have home and contents and building insurance. I think private health insurance is falling off a little bit, but it's about 50%. But only 25% of people have life insurance or income protection. So, and only 20% of those people are women. So it's very interesting. I think it's got a lot to do, this is just me thinking, I've got no facts on this, but I think it's got something to do with people perhaps thinking that they don't pay out, they don't pay out on claim time, or that they think they're protected within their super fund, or they think they're going to be protected by TAC or, they're going to be protected by Medicare, all those sort of things. And maybe it's also something to do with the Australian mentality of she'll be right.
Yeah.
I don't know. I think it's very strange, and I don't know whether it's something to do with the lack of connection with advisors who are sort of explaining what these things are. But they're so important, particularly as when you're young and you've got debt and you need to look after yourself. So, but the stats are scary.
Yeah, absolutely. I think they're pretty sobering statistics of people obviously underinsured. But let's jump into and look at each of those in a bit more detail. So when we think about life insurance, now it's obviously never a nice thing to think about our mortality there, but could you run us through how it works and why life insurance is so important?
So life insurance is really a policy that protects people that you care about. So it protects your loved ones. If you're a single person without children, you don't need life insurance because it's really there to help people that you leave behind if something was to happen to you. So life insurance is there to help cover debt. So, for example, you had a partner and you bought a property, you've got a mortgage, you need two incomes to actually cover the cost of that mortgage. You need to cover the debt so that if one of you wasn't around, you don't have to sell that property. If you've got children, you need to make sure that you've got enough money to cover yourselves if one of you wasn't around, and you've got to make sure the kids get through school. You don't have to sell property. You don't have to take them out of school. So it's really, life insurance pays a lump sum. So a lump sum is a chunk of money that gets paid out if you were to die or if you were to become terminally ill as well. So basically, when I talk to people, we always go through their individual circumstances, but that's really what life insurance is about. So you're alive or you're not, or you're on the way out, in a sad way of saying it, but it's to cover the people that you leave behind.
And I guess if you're in a relationship and your partner dies, obviously that's going to be pretty traumatic as it is, let alone having to worry about the financial burdens that may come up as a result of that.
Yeah, well, life insurance or any insurance is really the the thought process behind insurance is that it is there to help you be in the same position financially after an event. And so it's but exactly right. I mean, you can just empathise with anybody going through that that part of their lives. They've just lost their partner, and they've got to get on with life. And I mean, the last thing you want to be doing is dealing with financial distress as well as an emotional upset. So that's what it's for. It's actually to give you peace of mind, so that when the worst case a scenario happens, you are okay, and it gives you some financial resilience so you can sort of repair your emotional state and keep your family running. And particularly if you've got young kids, I mean, I hate to see young parents without life insurance, because it's a risk management strategy. That's really all it is. It's ensuring that you're going to be okay.
Yeah. Okay. No, I like that. When you think about superannuation, a lot of superannuation policies do have life insurance as a component. Does this tend to be enough? You alluded to that before, but does it tend to be enough, what we have in our super policies?
No, it doesn't. So I sort of do some seminars around the place. The default insurance within your superannuation covers about 30% of a young family's life insurance needs. So that's 1/3.
Wow.
More than 60% of families couldn't survive for more than 1 year if the main breadwinner passed away. So that's pretty scary.
Yeah, absolutely.
So people get a very basic amount of cover in their superannuation, and it really is not enough. So you have to have a look at these things. So don't get a false sense of security that you've got enough insurance under your super, because I can guarantee you, unless you've made an executive decision to have a look at it, you absolutely do not have enough.
So first action point I would imagine is get in contact with your super fund and find out how much insurance you do have. But in terms of working out how much we do need, what would you recommend for that?
Well, basically, what you sort of want to think about is, with life insurance, you want to, there's some, go to the Money Smart website, and there's that sort of explains all the different life insurance, or life insurance, total and permanent disability, trauma and income protection, explains that, so you can have a read through that. So with life insurance, how much do you need? You need to be able to extinguish all your debts, so your mortgage. You need to have enough money so that you have enough money that you can invest to create an income stream to replace the income of the partner that's died, especially when you've got children. If you don't have children and you're in a relationship and you're just paying a mortgage together, then maybe all you need to have is the debt covered. So it's all relative to your circumstances, but you just need to think about, well, the worst case scenario, how could I survive? What money would I need to survive if this happened? And those are the two things. If you've got kids going to private school, well, then you've got to consider those things as well. Yeah. But definitely debt. You've got to cover your debt position in a relationship.
Okay. Now, in the first episode, we talked about, we don't call it budgeting, we call it spending plans. And that could tie in quite nicely, I guess, because if you've got an idea about how much you need to survive, then you can use that as a starting point to look at your life insurance needs.
Yeah, absolutely. That's a really good point. So what I do when I'm talking to clients is I go back to their budget and say, okay, so for example, just as an example, I've got a family of 4 and they're spending $80,000. Now, I can say that each person's, it costs them $20,000 to live, and then if one person wasn't around, we can work out back from there. But it's best to work back from your own specific spending, because it's no good for me or anybody else to say, well, you would need $50,000 a year. Well, do you, or do you need more? The budget is always the starting point. So it does sound, the spending plan is, sorry, we're using the word budget, but the spending plan is, so you know what your life is costing you.
Yeah.
And then you know what you need to cover off on. So if somebody is not around and it's costing your family $100,000 or $80,000 a year to run the family, well, you need to be able to cover that cost. And if you've got young kids and you need to take time off work, you need to consider those things as well. But yeah, definitely the budget is a way to start with that.
In the opening, you gave us some stats, and it indicated that women in particular tended to be quite underinsured. I would have thought, interested to know what you find in your practice, because I would have thought men, we tend to think we're quite bulletproof, and I would have thought maybe women would be more pragmatic about their insurance needs.
Look, I'm going to say, I don't know whether it's going to be controversial or not. I think that half of the reality of this is that I think women are very aware of the risks surrounding these sort of situations. And because I deal with women generally, I deal with single women, but women in relationships and women with kids, the women that I speak to are extremely aware of the risk of if their partner wasn't around. I think it may have something to do with the fact that there is only 20% female advisors out there, and perhaps the women aren't getting spoken to in a way that they can understand what's important to them, or perhaps if they've had, it may be the basic, they've had time off work, or they don't feel that if they're staying at home looking after the kids, they don't value their the cost of that. So it's difficult to pinpoint it, but in fact, we're looking at these stats at the moment, going, well, why is that?
Yeah.
Because women are more risk adverse naturally, and I think it's just a matter of maybe thinking about these things, and what you want to ask yourself things like, what would happen if your partner wasn't there? What could you live on one income? Could you keep the kids at school and all those sort of things? And then also make the executive decision to actually look after yourself. I think women have a tendency to look after everybody else first. But if you can't look after yourself first, then you sort of end up becoming a little bit, you're sort of running on empty for everybody else. And you don't want to be running on empty if you've had a bad experience and you've had a death in the family. I can't imagine how awful that would be if you were financially distressed as well.
Yeah. No, excellent points. Excellent points. When you look, I guess, finishing that off, when you look at particular insurance, because it can be a bit of a confusing area, I know there's something called an any policy and an own policy. Can you talk us through that in a little bit more detail?
Yep. So when you look at when you all go and you make the call and you call your super fund and you find out how much life insurance you've got, and it'll also have something called total and permanent disability insurance with it. You may not have any insurance at all, but if you're in an industries fund, you'll have some, because they all have some. Total and permanent disability insurance, if you just think about those words, you have to be totally and permanently disabled, and at that point you may get a payout. The industry super funds, I'm going to put it out there, I like the way that they invest, but I do not like their insurances. They are really bad. They're the ones that end up on Today Tonight because people think they're insured when they're not. And any occupation is a policy that if you could do any occupation that you are trained to do, your super fund may decide, or your insurer may decide that, well, it doesn't matter if you're not making 120,000 or 80,000. If you can do a job that's worth 30,000, well, then you can still work in any job, and we won't pay out a claim. So that's an any occupation. It's not as watertight. You can have another occupation that is claiming your own occupation, and your own occupation is really talking about the occupation that you were doing before you went on claim.
Yeah.
So it also relates back to the amount of money you were making before you went on claim. So as a rule of thumb, I always first of all look at making sure you have an own occupation covered, and if you're working, you've got to work, a certain. If you're at home, if you're a homemaker at home looking after the family, then you don't have an option of either of those things. We talk about a daily living activities. So there are ways and means around looking at those. But own occupation is the safest. It's a bit more expensive, but you're much more likely to get a claim paid out than in any occupation. So I use the scenario of, so there's a nurse, she's working like shifts, she's on her feet the whole day or night shifts, whatever. She ends up getting a sore back or sore legs. She can't actually work as many hours, but she can sit and do a desk job. So she's been trained to be a nurse, and she's trained very long hours, and she loves her job, and she doesn't really want to sit in the office for 3 hours, 3 days a week. But because she can do some job that has been relating to her profession that she wouldn't be paid out. Now, if she had an own occupation that she couldn't do the wards and do that sort of thing, then she would be paid out on an own occupation, total and permanent disability cover, because she couldn't continue to do the job that she was trained to do.
Okay.
So
Excellent.
it's just, is that a good enough sort of?
I think that's great. I think that's really important, that distinction between any and own. So again, encourage people when you call up to find about your insurance to really find out about that any and own, because that can be, you can imagine when you actually need it, if you find out, I've got an any policy as opposed to an own, that again can be quite devastating, I would imagine, financially for people.
Oh, yeah. I mean, I don't know. I'm sure people remember the Today Tonight special and all that sort of, with ComInsure and a few other of the insurers that weren't paying out claims. Well, I would say to people that they were the any occupation within their super fund. So they didn't actually get the advice that they needed and had a false sense of security around what they were actually covered for. So, you want to, I'm a big believer in getting professional help with insurances, because they are a bit of a minefield and they are a little confusing.
Like most things, the devil's in the detail, right? Always,
yep.
So when we look at income protection insurance, now the name obviously gives it away a little bit here. Can you give us a rundown on what it is and how it tends to work?
Yeah, income protection is something that everybody needs. It doesn't matter whether you've got a mortgage, a partner, kids, or anything else. If you can't live on the sickness benefits or the disability pension that the government hand out, so I'll just tell you what they are at the moment. As of March 2018, the sickness allowance per fortnight is $545 for a single person, and $492 if you're both sick at the same time. A disability pension, that's for people that are on disability for quite a while, is $826 a fortnight for a single person. So if you just think about, that's it. That's all the money you're going to get. That's paying your mortgage. That's paying all your rent. It's paying your utilities, your food. Obviously, if you're sick or on a disability pension, you may also need transport. I think you do get some help with that from the government. But who wants to be poor and sick at the same time?
Yeah.
It's just the worst case scenario. So, and particularly if we're talking about empowering women and making right choices, well, then I would say that income protection would be the number one thing that I would be recommending people get. So what it does is it covers 75% of your income, up to 75% of your income, and it so basically, if you get sick, you'll get 3/4 of your income paid to you from the time that your waiting period starts, which we can go into in a sec, up to, I would say, age 65. So when you're calling your super fund, you want to find out what your they might not call it income protection in super. They might call it a salary continuance. It's the same thing. It's basically continuing to pay you an income stream while you recover. So,
okay.
And then you can put 10%, and a lot of the policies will put 10% into your super while you're on claim as well. So if you think about it, if you weren't working for 4 or 5 years and you weren't putting money into super, then you're also sort of reducing your ability to save for your retirement.
Around retirement, yeah. So
yeah.
You talked about super there. So does that mean that all our super policies would have income protection as a standard in it?
No, not necessarily. If you have nothing's standard in this industry, I can tell you that. So I would say that every industry fund may have a default, but it depends, you know. So I think you need to have a look at that. If you've got an employer fund, you may or may not have income protection. You may or may not have life insurance. If you've got your own fund, you may not have anything. But if you do have an industry fund, I think there is a default, but it's going to be minimal. It'll be something so small and a bit useless for you. So it's not going to be enough for sure. If you've got it, it won't be enough. So I can put money on that for sure.
Okay. So really the message is just don't take things for granted when it comes to your insurance, really.
Yeah, you are supposed to be looking after yourself. And looking after yourself is making sure that you're looking after your health and your wealth, and you have to protect yourself. And really that's what insurance is all about. I mean, income protection, it's actually using that word. You're protecting your income.
Yeah.
You're protecting your ability to live while you are recovering from an illness. I don't let people walk out of my office without going through this. And if they decide they don't want it, I have a file note and they sign off saying, well, we've discussed it and they've decided that they're quite happy to take the risk on. It's also the other benefit of, I should say, which is a good thing, is that because you're getting paid an income stream, it is actually a tax deductible expense. So the premium that you pay for an income protection policy is a tax deductibility. You send it through to your accountant, or when you do your own tax returns, that you actually can claim a tax deduction on it. So
that's an important point. Excellent. You alluded to before around the waiting period before you can claim. So I want to know what can trigger a claim on income protection, and the second part of that is how long do you have to wait before you can start to receive that benefit?
Okay, so income protection, there's two things when you look at income protection. One is that the waiting period can be anywhere between, well, let's say 30 days. So if you've got, what you want to do is, first of all, you want to look at your sick leave. How much sick leave have you got? Now, a lot of people move around jobs. People don't have 10-year jobs anymore. And I don't even know whether a lot of employees actually accrue sick leave anymore. So first thing you want to do is look at how much sick leave you've got, because the first thing that will happen is you will pay your sick leave will pay out first, and then you will start going on a claim. So usually I would say a 30-day wait would be the minimum that you would want. So 30 days means that you have to be sick for 30 days before you can put a claim in for your insurances. You can have a 60-day waiting period. So if you've been good and you've saved yourself, your 3 or 6 months worth of savings that we've been talking about, you could push your waiting period out to a 60-day wait, particularly if you've got some sick leave. You can go up to 90 days, and the longer the waiting period, the cheaper the premium. I always look at that for a client. So we want to be covered properly, but we want to be paying as little as we can for the protection that we need. So that's how we first look at it. And then what you want to do is have a waiting period to age 65, so that if you got sick and you were sick for a long period of time, that you would actually be paid out from now until the time that you would retire. So that's giving you complete peace of mind that if anything goes wrong, you're going to be okay.
Okay, perfect. The last insurance we're going to talk about is trauma insurance. So could you break this down for us and tell us what that is?
Yeah, so trauma insurance, and that might even sound, if you call or speak to somebody else or read something, it can be called critical illness. So trauma and critical illness relates to a traumatic or critical medical condition. So what I'm going to do is I might go through the claims for each one of these insurances at the end, just so you know how they all sit together.
Yeah.
But generally speaking, trauma is to do with stroke, cancer, heart attack, those big illnesses.
Yeah.
It was put in place in the 80s in South Africa, because what was happening before the mid-80s is people were actually dying from these conditions. But what with the medical advances and things like that, people were having these traumatic illnesses, but they were surviving and going broke. And so this trauma insurance is put in place. So it pays out a lump sum. So it gives you a lump sum to help pay the gap between what you might get back from Medicare, what you might get back from your private health insurance, and it also gives you some money to take some more time off work to recover from these illnesses. These are full-on illnesses. They're cancers, stroke, heart attacks. I mean, I can tell you, I'll just maybe go into it right now, but the claims for insurances for trauma for women, 80% of it is cancer. So it's breast cancer and ovarian cancer.
Yeah.
For men, it is prostate cancer and stroke and heart attack. So men have more sort of more heart conditions than women. So really that's what it's for. It's to help cover, I call it minding the gap. If you think about it like that, mind the gap, and that's what it's there for.
Okay, because the next question I was going to ask you was, if we have income protection insurance, do we really even need trauma? But I think you've explained that perfectly in the sense that it is for those more, for want of a better description, the acute costs that you'll incur associated with those illnesses.
Yeah, well, I mean, there was something on Four Corners the other day, and I've kept kept a sort of record of it, talking about the gap between what actually happened. So, and I've done a lot of research into this too, because I wanted to make sure that my clients weren't getting overinsured for things that they didn't need. I would say that you'd need at least $50,000 worth of trauma insurance to cover the gaps of things. So, but having said that, if you've got enough money sitting around and it always relates back to your own circumstances. And if you can't afford all the insurances, then what you do is you look at them all as a package, and then you go back and make changes to things. So trauma, I think everybody should think about, because it is actually the most claimed insurance out there. That's why it's the most expensive as well, because people do tend to have these illnesses. But, at Four Corners, they had somebody that out-of-pocket expenses for breast cancer treatment was about $20,000.
Wow. Okay.
It's a lot of money.
Yeah, absolutely.
This is after everything and having private health insurance. So, and I've spoken to quite a few women who have had breast cancer, and it's the other little things too. It's like, you have to have, you can't drive yourself around sometimes, all those sort of things you've got to think about. Yeah.
It does add up. So I'm starting to get a bit of a picture now about the different types of insurances, but how do they, or you said you'd run through in a bit of detail about how they all interplay with each other and pay out and that sort of thing. So could you run us through a bit of maybe an example on that?
Yep. So, okay. So I'm going to go worst case scenario. You could claim on all 4 insurances all at once. So let's say we have a client who has cancer, who is terminal, who cannot work, and who is having treatment. So basically how that would work, this is worst case scenario, and then I'll go back to something else. So they can't work, so they've claimed on their income protection policy, so they're getting 75% of their income paid. They've put a claim in for their trauma because they've had a traumatic illness, being cancer, and they've had a payout for that to help them with their medical expenses. Their treatments haven't worked, unfortunately, and they have been told they have only, a couple of years to live, something like that. So they have been diagnosed as being terminal. Yeah. At that point, your total and permanent disability insurance would pay out, and at the time of your death, then your life insurance would pay out as well. Yeah. So depending on whether they've been linked together, but we won't go into that at the moment. But so that's worst case scenario, and I always give that as an example to my clients. Say you broke a leg and you couldn't work, you couldn't get on public transport, you had a bad back or something like that. You would be going out on a income protection claim, because you would you're not totally permanently disabled, you are temporarily disabled, and you would claim on your income protection. It's not a traumatic illness as such, because it's not one of the illnesses that are covered with your trauma policy. But if at some point your back or your leg or something got so bad that you could not work, and the biggest claims, I'll tell you what the biggest claims are for all of those things in a minute, but you would be claiming, if you couldn't go back to work at all, you'd then go claiming on your total and permanent disability cover. Sure.
Yep.
Life insurance may be that somebody's around 1 minute and they have a massive heart condition or a stroke or something, and then they're not around. Then obviously the life insurance would pay out. But it's pretty common that you could be paying out on 3 policies at once. Your income protection, your trauma policy, and could eventually be a total and permanent disability cover as well. So they do interlink. So that's why you got to look at all these things, and it's really good to speak to an advisor about this, because it is a bit complicated. And it also you can organise these things so that you get really good cover. So you're not using their policies within your super fund, but you're actually using really good quality retail products that you can use your super to pay for it. But you really need advice from an advisor to actually help you how to structure these properly, and then it's a matter of making sure it all works for you. So what I say to people, this is part of the puzzle. You've got to protect yourself and your family and your assets, all those things, but you've got to be able to afford it as well. So you've got to still pay the mortgage. You've got to still put money in super. There's only a certain amount of money you've got, so we've got to make sure that it's viable. And that's the benefit of advice, really. You're marrying everything together. You're making the decisions, the educated decisions, and you're cutting the costs where you can and increasing, you're just making the thing work for you as a person. So everybody's so individual. Everybody's life is so different. You have to sort of look at these in, for each person.
And I guess that links into the idea of needing to review it fairly regularly. Would you say, every year, every 2 years?
So with insurance, I would say every time you get a pay rise, you want to look at your income protection. So you want to always, I would say, the way we are, and look, we've just had a conversation about it in another episode about people spending more than they make. Well, try and live on 75% of your income. That also gets taxed. Your income protection also gets taxed. So you get 75% of your income and it's taxed just like your normal income. So you will find that if you want to increase your lifestyle and what you're doing, once your income goes up, I would be looking at your income protection and making sure that's covered up to 75% of your income. If you have kids, you want to have a look at your life insurance. If you take on a bigger debt, you want to always look at your life insurance and total and permanent disability cover, and trauma. And the thing with all of these things is, look, once a year is great, but I think it's always good to look at everything once a year. But every second year would be fine as well. But anytime there's any changes in your life circumstances that you need to have a look at this. And you know what, as the kids, if we're talking to, young mums and young families, the time of your life when you need the most insurance is when you are just starting your family and you've got a big debt. As your children grow up, as your debt comes down, as your super increases, so does your life insurance, and your total and permanent disability cover should decrease. So it's a moving feast. And as your income goes up, so your income protection should go up to match your income and your ability to earn an income. Your ability to earn an income is actually your most valuable asset. It's always going to be more than your house. It's always going to be more than your super, and you need to protect that. So hopefully that sort of explains things.
No, look, that's great. You've really shed some light on a pretty complex topic. So thank you for that. If the listeners wanted to get in touch with you to find out more around you and what you do, what's the best way for them to get in touch?
Yes. So I have a website called Nicole Heals Financial. So it's an NICOLEHEALES financial.com.au. I've got lots of great articles on my newsfeed there. So you can sign up to my newsletter. I've got a Facebook page, Nicole Heals Financial, Instagram page, I think is Nicole Heals, and a LinkedIn page. My phone number is 0417 167 024. So always welcome to have a chat. Sign up to the newsletters. They're always they're easy to read. I mean, my whole focus is helping women get engaged with their finances, and so there's no jargon, and I try to keep it as light as and as simple as it needs to be. You don't need these things to be too complicated. No. So happy to help.
Perfect. Well, thank you very much, Nicole.
My pleasure. Thank you.